Take it away, Ignacio. Round of applause, please. Thank you.
That's yours.
Thank you very much. Good afternoon, everyone, and thank you for being here. I hope in the next 30 minutes you'll get a clear idea about alternative financing solutions. My name is Ignacio Puig. I'm investment director at Inveready. Okay. So let me introduce you this wonderful panel. Sergio, Pérez from Banco Sabadell, Hristo from the European Investment Bank, Bryan from Habert, Matteo from Kreos, and Craig from Columbia Lake Partners. Can you explain briefly about the funds or institutions you are presenting, please?
Yes, Kreos is a venture debt fund. It's in London. We have been around from 1999. We invest on a pan-European basis. I mean, we are agnostic to industry and sectors. I think in terms of tickets, we can do everything from 3 million to 50 million now, or even 100 if we syndicate with other investors. But our sweet spot historically has been between 3 and 10 million, and that's it.
All right, over to me. Habert European Growth Capital is backing expansion stage companies in Europe. And more recently, we did our first Asian investment, so slowly extending Europe. Over the last 6 years as a team, we've done about 100 investments. We love Spain. We have 6 Spanish investments, Job and Talent, Medux, Exotica, I'm going to get this wrong if I miss one, PackLink, World Sensing, and Promo Pharma. And we'd love to do more in Spain. Our check sizes are starting at 2 million, and they go up to 30 million. And we're a good partner for companies that, without maybe tweet length, but, I would say when they have a clear direction, we're a good partner to help them with that expansion capital.
Okay. Great. Craig Netterfield, Columbia Lake Partners. So we're a European debt fund. It's a small market, the debt fund. It may look like a crowded panel, but other than maybe having Craig Fox from Silicon Valley Bank, you've kind of got the whole market up here. As opposed, if you had venture funds, you'd have the whole room. Everybody would be. So we funded 50 loans into European companies. Average check size around 4 million euros. We'll do up to 15. I came from the U.S. market and brought 3 more people over from the U.S. market, so we've got really strong ties back into the U.S. market. So we like companies that have sort of the aspirations of expanding into that market, and we can help them out with that and open up our network. So that's us.
Sergio?
Okay, so I'm Sergio Pérez. I work in Sabadell Venture Capital. It's the venture capital branch of Bank Sabadell. And in our case, maybe we are the small brothers, 4 of them, because we are the locals. We provide a venture capital from seed to Series A, and also venture debt behind them. I mean, we usually lend between 1 million, 2 million. So usually it's like, I always like to compare seed, Series A, Series B. So we are the seed or Series A of the venture debt. Right now, our average ticket is 1 million, and we provide debt to 10 companies. We started 2 years ago as a new activity because in the bank we try to cover all the financial needs of the company. So we have one branch that is a B startup, in which I always say that we like to speak the same language that the entrepreneurs do. Why? Because usually the banks speak Chinese and entrepreneurs Spanish. So B startup, they try to translate one language to the other to try to provide financing to them. We have the venture capital division, so when the companies are growing, we have the seed and the Series A. So we try to go together with them and share the risk. And after that, maybe between bids, maybe because they want to grow in the M&A, something like that, we can provide also venture debt. So we are the small brothers, but we try to help the company since the beginning.
Hristo, please.
All right. Well, thank you. Well, first of all, thank you all for taking the time to listen to us today. As you heard already, it's a very small market in an exciting place, to be honest. My name is Hristo Stoykov. I'm heading the venture debt team of the European Investment Bank, which is the elephant in the room, I guess. We have 600 billion portfolio. We are owned by the member states, and we do invest in early stage companies through venture debt product. We are also the parent company of EIF, which is the European Investment Fund, and therefore, through their 10 billion equity investment portfolio in Europe, we are indirectly a supporter of many, at least some of the Americans or the Europeans. I think, on the stage here and the VC funds as well. We have started 5 years ago the program for venture debt investing. It was a story that began with a study of around 30,000 startups across Europe, and we realized there is a huge gap, and we're going to go to that point, I guess, later. And based on this huge gap, we created a program which is unique in the world, like in a way that we have structured the financing because we thought that we are actually complementing the lack of venture debt or long-term capital in Europe. So started 5 years ago. We have a team of 30 people covering the whole EU, and currently we have managed to build a portfolio of 2 billion euros, mostly high-tech software and biotech type of companies. So I'm happy to discuss, of course.
Thank you. By the way, Inveready is the first venture debt fund in Spain. Sorry, Sergio. Back in 2012, we started operations. We've done more than 40 deals. We are a huge team of 3 people, and well, that's who Inveready is. So, as most of you probably know, venture debt is debt. So it avoids dilution to the current shareholders and the founders. Besides that, why do you think venture debt can boost your company to the next level? Why would you choose venture debt instead of equity, or when? Anyone can start.
Sure, start. I think venture debt. I think I don't like to look at it as a way of substitution of the VC investment. I think it's a complement to it. I think it gives both the company and the investor the opportunity to optimize the value of the company. So I mean, for example, if you take venture debt, and the debt can extend the runway of the company for 1 year. In that 1 year, if you're a company that are growing 100% per year, obviously the valuation that you will take at your next round is going to be much higher. So I think that is, it has to be seen, as you say, as a way to boost growth. I don't like to think about that, as a substitution of the equity. I mean, then, there are a number of use cases that you can use that for. I mean, at Kreos we have done more than 600 investments in 20 years, I think, and not only for this, but we funded acquisitions in the past, because if you want to fund an acquisition, doing that with equity is really expensive. So obviously debt is a more appropriate tool to use, for an acquisition. We used venture debt in the past when the company was trying to switch from enterprise sales to SaaS sales, and obviously, once you do that, your working capital, the working capital of the company is worse. So obviously, you need a bit of more cash headroom to do that switch. I think the classic case is the one of having more optionality and more cash runway. And I mean, even if you don't extend the cash runway, venture debt can give you options to do things that are not in the business plan. So if you raise a round and the plan is to do A and B, okay, then at one point you think, okay, I would like to do C as well, okay, but obviously you don't have the cash from the investor. So you raise venture debt because you want to try another vertical, a product, or you want to do a test. So it gives you many things, and so I think it's an instrument all the companies should take into consideration at based on the use case that they want to achieve.
I would just echo one thing you said, which is it's not a binary outcome between debt or equity. As a distinctly average seed investor, angel investor, the risk profile of both those investments are completely different. And if I was to use Donald Rumsfeld's paraphrase, right? Debt is great for the known knowns. When you get to a certain product market fit, and I know I hate that word, and you've probably heard it a million times at this conference, when you have revenues and you've got a clear, go-to-market strategy, debt is a great way of those known knowns, your customer acquisition model, your LTV to CAC. And there are a lot of good companies out there that maybe don't have the metrics to raise to the next round. They have to get their churn down, they have to get their customer acquisition costs down. Oh yeah, sure. All right. Is that better? Is anyone else? All right. I'm whispering because, yeah. All right.
It's all the secrets of venture debt. He's keeping it amongst the group.
I think really low. So
yeah, is that better? Is that better? Yep. Anyway, Yeah, so as I say, the known knowns are, as I say, you're trying to ameliorate certain things, be it internationalization, metrics, to raise that next round. And at the later stage, I think debt's a great way of arbitraging return expectations. I don't know how many investors are in the room, but early stage investors might find it hard to follow on. They have certain return expectations, from their own investors. And there's a great arbitrage opportunity for debt to fund the proven winners, where the return model of debt is better suited to getting the company a better outcome. And we've seen that in a number of our companies, on the expansion stage with Exotica, where we extended the runway. They got a very good round away fairly recently. And we're seeing the proven winners in job and talent, where we're investing in, as I say, a very fast-growing, exciting company that has actually got the ability to go out and be one of the, Spain's, hopefully first unicorns.
I have one question for Sergio. Sergio, since you are equity investor in Exotica, for example, and Bryan is the provider.
I should just say thank you for making the introduction. Well done.
So how do you see the venture debt from the other side, from an equity investor?
Okay, so for example, in our case, even we provide venture debt and venture capital. We are in the venture capital in the seed and Series A, and in the venture debt, the same, in the seed and Series A, but in that area. So usually we don't mix venture capital with venture debt. So for example, in companies that they are looking between the Series A and Series B, we can introduce our colleagues because they can provide venture debt to that companies that they are bigger for us, and they can provide that. So for us, it's fantastic because as an investor, we have always the compromise if we can provide more equity to the company or we wait to provide more equity in the next round. Why? Because usually the investors in Series B, they want that the investor in Series A, they say, okay, I'm looking for 10 million, 8 million, but that the current investors invest some quantity. So as we have a limited pocket, we can provide, for example, we invested in the Series A, and then we keep money for the Series B. And in that case, our colleagues, they can help to increase the run rate of the company and also to keep with the same KPIs. Why I say that? Because, and now I put the hat of the venture capital, okay? That usually when you are dealing with a potential investment, you try to negotiate with them, but, okay, don't record that, okay? But you are waiting because sometimes they have a cash constraint and they don't have a lot of cash, okay? So you are dealing, you are speaking with them some things about the shareholders agreement, but they don't have too much cash and you feel more comfortable because maybe you say, okay, now the negotiation is going to be easy in this side. And these guys, they help them. Why? Because it's better to negotiate with cash in your bank account than without. And they can help in that because it's a good company. There are a lot of investors who want to invest. For example, in the case of Exotica, they really help us. We have different term sheets. In that moment, we decide, okay, we would like to increase our revenues, to increase the valuation, and we prefer to have venture debt than the current investors to put money. Why? Because we keep that money to say, okay, the valuation is this figure, but the current investor we are going to invest. So it's a perfect complement for us, especially for the investor in Series A.
Yeah, there's a number of different use cases and where the life of a startup has lots of ups and downs, right? And there's that bumpiness in the road, we can really help smooth that out. So the classic use case of extending the runway to get to the next round, but with one company in our portfolio, Falcon, we did that. We did €5 million loan to them, and then about 18 months later, they need a little bit more money to get a little bit further, so we just extended that out and did that. They could have used, to your point, they could have gone to their investors to fund that. It kept some dry powder, right? So now the company has the optionality of, I still have those reserves available to me later. I don't have to spend that money now, right? Then come to us to do that. And then they want to do a small acquisition. Again, it was a €4 or €5 million acquisition, and we just added on the loan, got it closed in 2 or 3 weeks. It let them move quickly, solved problems for them, right? And there's a lot of different use cases like that we can help out with.
Okay, so you like trenching. you like tranching those loans? I mean,
Well, in that case, the loan, we had an initial loan, and then the one thing that you know with startups is that you'll have a plan, but it's not going to unfold exactly as the plan is. So with this company, just things came up. They had market opportunities that they could take advantage of that we were able to step in and help fund those. So it was just new deals because new things came up for that company.
okay. So I guess we all are looking for growth, but what are the main KPIs, not only from a growth perspective, but also on a financial perspective that you look in the companies? Maybe you look at their balance sheets, or what do you look?
Yeah, look, we obviously you look at how much cash there is and you runway without how much we've loaned and runway once we come in, and we like to see anywhere from 9 to 18 months of runway after we fund. And you know it's not going to be that. It's going to shorten up, but at least it gives you a little bit of flexibility. We really look at, if we're extending a company out to their next round, we want to know, does this company look like a rational, Series B or C or whatever investor is going to fund it? So ultimately, that really brings us back to looking at the same kind of KPIs that the VCs are going to look at. So if you're talking about, as Bryan mentioned, CAC, so you're looking at acquisition costs, is that where it should be? It might not be, but is it trending in that direction? If you scale up a company with a high customer acquisition cost, it just becomes really expensive, right? So we look at things like that.
I think it's easier to ask the other way and say, is this an unsustainable business? And, as Greg mentioned, there's no kind of secret sauce. It's the same playbook that any VC would look at,
Yeah.
And I think, we're not banks. I'm not saying that banks are bad. I'm just saying that really the mentality that we have in the asset class is more a VC mentality when we look at the business. So we want to see growth, gross margins, LTV, CAC, as you touched upon earlier. So I think, when we evaluate a business, yes, we look at the financing risk of the business. So will the business be able to raise additional funds? But that is driven mostly by the fact that the business is a good business, is improving, it has a market. So at the end of the day, yeah, we look at the financial risk. So can the business raise more cash? But that is driven by the quality of the business and the growth rates.
Okay. So most of us are used to do deals with companies already backed by a VC, by equity VC. How do you see the relation with these equity venture capital firms and also with Spanish equity venture capital firms? Anyone has some experience here?
With the VC, I'm not that old, so I've been in the market only for 4 years now. But I think that in general, if you look at it, has changed a lot in the sense that, historically when the asset class launched, VCs used to come with the worst companies of the portfolios, okay? And they were like, can you give me some debt for this company? I think that has changed massively now, and they also understand that, debt is an instrument that, has to be used with a positive story and growth. So, they understand why they have to use debt, because, as you were saying earlier, as a venture capital, having debt in a company, it has a number of advantages also for the VC. So I think the relationship is good. I think, eventually, I'm speaking for Kreos, but I think half of the deal flow that we have comes from the VC themselves. And the rest is CEO and management, because, we also do our own things. We're not an LBO or asset class, so we need to go out in the market and speak with entrepreneurs. But I think, the relationship we have is really good. And obviously in some markets, for example, in Italy, I'm Italian, so there's a bit more education that has to be done to the funds as well. And I think, probably even in Spain sometimes, but, I think it's good.
To add what Matteo said, for example, you are working as a pan-European, so you can see different markets, but we are a domestic one, so usually we operate in Spain. And I would like to add what you say, that it's true. The Spanish market, for example, Inveready started, they start evaluating the market because they were the first ones to provide venture debt, but still it's something that you need to work with the market to be enough mature, because in your case that you have bigger pockets than us, and your check is bigger than us. And usually, you put the money with international VCs from Germany, UK, that they are more used to venture debt. Here, I think that things are improving, but still, sometimes there are some kind of investors that they say that it's debt. And we need to educate them to know that if the figures goes as we expected, it's better for everybody, because the return for them is higher if you provide debt, because you don't dilute them, and also for us, because we have companies that they can go to the next stage, to the Serie B.
Yeah.
Okay.
I would just say, just one thing is, we wouldn't have done the investments we did in Spain without, kind of winning the trust and the credibility of those investors, right? And, we look for the same thing, in those investors, which is, commitment on both sides of the table, that kind of mutual respect and credibility that you have for one another is so key. And I think, similar to what you were saying, as I was saying, Matteo, most of our deal flow does come from investors, because over time we do build that credibility, and it's key. We wouldn't be where we were without those guys. So.
Yeah, both sides need to have confidence that the other party is in this for the long term, and we recognize at CLP that we sit in a privileged position, right? We sit at the top of the above all of the equity on the cap table, and that it's founders and VCs that let us sit in that position because they understand our dedication to doing this in the long term. So that's just, to Bryan's point, that trust is just such a big part of what we do, which is why there aren't many people who do this, right? You'll see players come in, occasionally dip their toe into the market, because frankly, it's a higher yielding instrument than you get from a typical bank loan. But it's like that for a reason. And having that trust is really important, and that's just, evidence of that is, as Bryan says, and Matteo says, most of our deal flow comes from VCs. Right? You've been through some of those tough situations with them. They see how you act, and they want to work with you again. And that's great. It's really rewarding.
Okay, just one last question. How do you see the market in Europe, and especially in Spain? We already talked about the market in Spain, but how do you see the whole market, the ecosystem in Europe?
Sure, if I can take that. So I moved my family from Toronto 5 years ago, my wife and my young kids, to set up a fund to do this in Europe, because I believe the market in Europe. Here's the pitch I gave my wife. Venture capital is growing in Europe, and it's going to keep growing, and the use of debt is relatively nascent in Europe, and that'll keep growing. And if one of those things turns out to be true, we'll be fine. And if both of them turn out to be true, we'll be early days building a great business. And so, full believer in Europe. We've packed up everybody and moved over here for that. And the Spanish market, we've funded one company in Spain. We've lost a bunch of deals in Spain. We've had active term sheets out. I'm meeting with 4 companies tomorrow with one of my colleagues. It's a good market. Growing market earlier than some others.
Okay.
And I think for the kind of companies that we like, it's probably 2, 3, 4 years from now, there's going to be a lot of big companies.
I didn't have to convince anyone to do this job.
I think Hristo wants to say something. Hristo has the whole picture.
I don't want to sound arrogant, but I think I represent the only institution that have invested in all the countries in Europe. So I cannot know the answer to that one. But I don't know if that works anymore, but I'll try to shout. My take is this, like, when we look at the European market, and now we have the biggest venture debt portfolio in Europe, and we managed to build it very quickly, and I'll tell you why. As an investor in most of the VC funds in Europe, we see that the VC market is evolving. It's still 1/5 of the American one. And the American one, usually venture debt represents around 15% of the market. In Europe, the market is 5 times smaller, and the venture debt represents 1 to 3% of the market. This discrepancy usually holds in Germany and France. So Germany and France attract around 60% of the market. With the Nordics and UK, if we count UK out, but let's say include UK, those regions usually account around 80% of both venture debt and venture capital markets in Europe. Venture debt did not usually, you could not see it in Eastern Europe. You still cannot see it. Eastern Europe still accounts 1% for both venture debt and venture capital in Europe. South Europe, there is a big discrepancy. Spain is catching up in terms of venture capital. So you still, I think, see around more than 10% of the venture capital market being now done in Spain, but the venture debt market is in the low single digits. I'll put it at 1 to 2%. So in many cases, when we approach certain companies, we do partner with VC funds. And like I tried to put this message in the beginning across. What Europe lacks is a long-term, stable financing for innovative businesses. Usually venture debt has been used for working capital. Think about credit card. You want to build a house, you don't build it with credit cards. So like people used to use credit cards, like type of 3-year amortizing loans to fund their working capital. What we have issued and basically offered to European companies over the last 5 years, and it's been taken phenomenally well, is very long-term debt, patient debt, with large tickets. Why? Because there are no large venture capital tickets in Europe, and certainly there are no large venture debt tickets in Europe. So if you're an innovative company and you need stability and not to go the hamster wheel and raise the next and next and next funding round, maybe you should consider check our website. I can tell you, like, you will be happy about it. We were thinking of changing the name from venture debt to adventure debt because it takes around 8 months to close the deal to 12 months. So like being an institution, we are very difficult. You're going to hate us, but you're going to love us also because we can be very patient. And everybody who's been like through the whole funding round with us can see that. And we hope that by doing that, we saw that some of our colleagues here on the stage started exploring the opportunity of giving a bit more long-term financing, which is good. But still, the venture debt market should grow both in size and relative size to the venture capital market in Europe. So that's my take. I don't know if you agree with that.
I think we're running out of time. Yeah. Well, thank you all for coming, and remember that debt is good, okay? Thank you.
Thank you very much.